Hello there, my name is Harmon Scuttlesworth. I am a CPA by trade and a teacher by heart. And today I'm going to talk to you about how to become bankable. Key, of course, for any entrepreneur.
Hey there, Harmon. We kind of need to hustle along here. This will be
of course, we will go ahead and go straight to the video. And I am not a technology person.
Harmon, actually your VHS tape's right
The
there.
problem reveals itself. Will you go ahead and put that in and get us started? And I'm going to talk a little bit about the key for entrepreneurs here.
Oh, wow, Harmon. Did you see that Picket N4ES slide rule outside in the rain?
People never learn.
Yeah. All right, well, while Harmon has gone looking for the slide rule, let's talk a little bit about what it means to become bankable. Now, becoming bankable doesn't mean that you need to learn how to become an accountant. In fact, to a lender, it just means that you're able to show them that your business is financially viable and that you'll be able to repay the loan to them later. Let's talk about what you're going to learn from this video. First, how to understand and review the basics of financial statements, since it is the first thing a lender will want to see from you. What specifically a lender wants from you, an existing business, or what specifically a lender wants from you, a startup business, what you will need to take to the lender, and lastly, SBA loans. Let's talk about what the lender will always ask for first, your financial statements. Your financial statements are the clearest and easiest way to determine how bankable that your business or even potential business truly is. Consider it like scorekeeping in a game. Let's say you play a game and you played really hard, and at the end of the game you feel good, but then you realize you lost by 20 points. Now, if you'd have known that earlier in the game, wouldn't you have played just a little bit differently? Well, a small business is no different. They need to keep score and understand how they're doing. Let's take a lemonade stand as an example. A lemonade stand has a location, they sell a product, they pay their expenses, they carry debt, and they need to manage their money very carefully. Income statement. This shows how much money your business is making and how much money your business is spending. And think about your business, if you will, as a story or a movie. The scene is always developing. And that's what the income statement is for your business. It's constantly showing how your business is always developing and where it's going. So what makes up an income statement? Revenue. Revenue is the amount of money that you make. This might even include income that you've generated and haven't even collected yet. Next, cost of goods sold. Well, really, that's the stuff that you sell. In this case, for the lemonade stand, it could be the lemons, the water, the sugar. And if your business doesn't physically sell a product, it could be the service, the money you have to pay out for the labor to get that service over to the customer. And cost of goods sold is variable. The more you sell, the higher the cost of goods sold. Gross profit. This is the profit that you've made after you've paid for the cost of goods sold. So essentially, money I have left over after I pay for the lemonade and the lemons and the water and the sugar and the cups. Next, operating expenses. Well, these are the regular expenses that you pay on a regular basis. And they can be things like rent and insurance and advertising and payroll. And in this case, we're going to look at insurance, advertising, and rent for the lemonade stand. Operating expenses are not tied to sales, and they're virtually the same each and every month. And that leaves us with net profit. Net profit is the profit that you've made after you've paid the operating expenses from the gross profit. Essentially, it's the money that you have left over in your business after you've paid everything else. Now, what would your business look like if someone snapped a picture of it? That picture would capture a moment in time. Well, that's essentially what a balance sheet is. It's going to show the stuff that you have and who owns it. Assets. What are assets? Well, it's just stuff the business has. It could be money, accounts receivable, equipment, and in the case of a lemonade stand, well, it's the lemonade, but it's also the cash, IOUs that the lemonade stand has collected, and even the stand itself. What's next? Liabilities. And liabilities is money a business owes someone else. And in this case, the lemonade stand owes its local grocer for the things that it bought to make the lemonade, and it also owes the lender for the lemonade stand itself. Now what's last? Equity. Equity is just assets minus your liabilities, and that's going to show how much value this lemonade stand or business has. Cash flow statement. The cash flow statement is the most underrated and maybe the most important of all three financial statements. It's going to show how much cash your business has on hand at any one point in time. It has elements of both the income statement and the balance sheet. Money as it flows in and out of your business, like the income statement, and how much cash you have at any one point, an asset in your balance sheet. First, cash at start. How much actual cash is in the bank account at the beginning of this particular period. Cash in. How much actual cash is coming in from either sales or borrowing. Cash out. How much actual cash is going out for either expenses or purchases. And cash at end. How much actual cash is in the bank account at the end of this particular period. Each of these three reports need to come from an actual accounting program like QuickBooks or something very similar. The days of the double book entry in a journal or the shoebox of hope are finally behind us. Good thing for that. All of the transactions that are entered make up the chart of accounts. The chart of accounts is simply what category all of your transactions go into. Assets, liability, equity, income, and expenses.
People never learn.
Yeah.